Okay, so this is depreciation, and this is the second little clip on depreciation. Just want to go over a few basic points with you. First one is policy. The policy note on depreciation might be something along the lines of non-current assets are written off over their useful economic lives. It might give the method, for example, straight line. There are other methods, such as reducing balance. The difference is this: straight line has the same depreciation charge each year. Reducing balance depreciation means you need to look at the net book value and apply a fixed percentage to the net book value. You won't have to work out what that percentage has to be to get down to a zero net book value at the end. You'll be given a percentage, you just apply it to the net book value, i.e. the cost less the accumulated depreciation so far. Okay, so that's the method. Application: the way the depreciation method is applied may be typically in one of three ways. Pro rata, so that if you have an asset for 6 months, you have 6 months of the annual depreciation charge. It might be that a standard policy will be full depreciation year of purchase, none in year of sale. So whenever you buy the asset in the first year, there's a full depreciation charge, never any in the year of sale, or the other way around, no depreciation in year of purchase, full in year of sale. That's how it can be applied. Revaluation. Revaluation is significant as it affects depreciation for the following reason. Let's say we bought a building, cost 100, and the useful economic life of the building is going to be 5 years. Straight line depreciation each year would therefore be 20. 20 a year for 3 years would leave you with an accumulated depreciation of 60. So that would mean at the end of the third year you would have a net book value of 40. The amount of cost that you haven't used up so far will be 40 net book value. Let's say the revaluation amount is going to be to 120. 120 revaluation amount. You go from net book value to the revalued amount. That gives you the amount of the revaluation, 80. And I've credited this to this account called revaluation. In a limited company it would be called revaluation reserve. It's part of equity, or it's part of capital, because your assets get bigger. Revaluation means you improve the size of your assets, so equity therefore grows. But it's not realised profit, nonetheless it is part of capital, part of equity. So credit revaluation reserve. And one way to think of this for the bookkeeping entries is that at the point of revaluation you have effectively got a new asset. You revise or you look at the remaining useful economic life. In theory it's still got 2 years to run here. It may be 4, it may be 1, but I'm going to assume it's still got 2 years to run. And we're going to start from scratch depreciating again, because the old asset effectively is gone and the new revalued asset comes into play, and we're going to depreciate that fresh from the start over 2 remaining years. So one thing we're going to do is remove depreciation. The old depreciation amount disappears. I'm not going to label it, I'm just going to take it away because we're starting from scratch on a new revalued asset. So we've credited the revaluation reserve, difference between net book value and market value typically, the revalued amount. Credit revaluation reserve, remove the existing accumulated depreciation, so we can start from scratch, and then we debit building to show the new revalued amount. So the new revalued amount is 120. So debit 20, debit 60, total debit's 80, credits 80. So it works. So we've revalued the asset at the end of the third year. So the question is, what will the depreciation charge then be for the remaining 2 years based on a straight line approach? Well, the depreciation charge for the 4th and 5th years will be now the revalued amount, 120, divided by each of those 2 years would be 60. So we're going to write the asset off over its remaining useful economic life of 2 years, no residual value. If there had been a residual value, i.e. a scrap value, we wouldn't have depreciated in it. If there was a scrap value of £10, we'd only depreciate 110 over the 2 years. But there's no scrap value here, so the charge is 60 per annum. So at the end of the 4th year, there would be accumulated depreciation of 60, and at the end of the 5th year, there would be accumulated depreciation of 120. Okay, so that's a little bit more about how depreciation works.